Thank you for having me. How y'all doing today? Good. So I want to tell y'all a story. A couple of years ago, I had just come back from the vacation of a lifetime. I was in Portugal with my husband and my children. You'll learn more about me as I tell you the story. But we had just got back from Portugal and I'm feeling good. And I come home and, you know, as you travel internationally and you travel with a big family, you come home, you're exhausted. So this Saturday I come home, we got our bags and stuff, and I'm like, okay, I'm gonna relax tonight, and tomorrow I'm gonna be really, really productive. So I go to sleep and I wake up the next morning and I go downstairs and I pull out my computer and I'm sitting down and I'm doing, you know, checking email, just catching up with life because I've been gone for 2 weeks, living my best life. So I'm sitting there on the computer and I see something fall from the ceiling. I say, is that water falling from the ceiling? So I get up and it was just like water just pouring. And I'm like, oh my gosh, honey, the water's coming from the ceiling. What is going on? We got a pipe bursting. Something is wrong. So he's running upstairs and we're looking. It's like completely dry upstairs. But it's this water coming from the ceiling. So I have a handyman. His name is Brandon. So I call him. It's Sunday. I'm like, all right, Brandon, I really need you to come out here. So I need you to look. It's something going on. I got a leak. So he comes and he looks, and at this point it's not pouring anymore, it's just damp. So he goes upstairs, he's like, I don't see evidence of a pipe burst. So he's like, the only way to find out is to bust open the drywall and the ceiling. And I'm like, dang, I just came back from vacation, I just spent all this money, I'm not trying to do that. So anyway, I was like, you know what, I don't care. Because I don't know if you all have ever dealt with water damage, but that's not something that I'm trying to deal with. So I said, I don't care, bust it open. Let's see. So he busted open, touches the pipes are dry. So I'm like, it was water just falling from here. So he's, you know, touching around, and then he touches the, I forget the vent, whatever the stuff is connected to the vent, I can't think about it.
The insulation?
The insulation. So he touches it, and it, you can just hear it, shh. So he said, was somebody pouring water down the vents? So I thought about it and I was like, I did see my son in the bathroom this morning with cups of water. So I called out to my son, I said, Caleb, I said, did you pour water down the vents today? And he was like, yeah. He was like, I was trying to see, he was trying to test something. Like he's one of those kids that are into like science, math, and technology. So he's doing some sort of experiment. I had the bust open ceiling, and now I'm just like, oh my gosh, I pretty much wasted, you know, time. Could have just dried up, whatever. But anyway, long story short, after this trip, I had to pay Brandon, and luckily he gave me a little discount, $800 to come and seal it back up. So, what I wanted to talk about was, are you prepared for an emergency in your home? Because no matter where you are in the process, stuff happens. And you the landlord of your own property, so you have to pay it. And then my question is, well, how are you paying it? Are you prepared for an emergency? I teach financial coaching, but I also teach taxes too. But before we get to the taxes, I want to talk about living a debt-free lifestyle. So when these things happen, you're not trying to figure out how you're gonna pay for stuff, where you're gonna get the money from, because there's a study that came out in January from CBS, and it says, I'll get my numbers right, 59% of Americans cannot cover a $1,000 emergency. You'll be in a rough spot. So my goal is to not have anybody in that spot, you know, because a lot of things we just weren't taught. So the key to being prepared for emergencies, whether it's your own home or rental property, is having cash. But also, on a personal level, having a budget so that you can work towards your goals, work towards savings, and just managing your life with a budget so that you don't have to be in debt. And I'm very passionate about this because in 2021, Patrice said I left my job. That's also the year I became debt free. So I used to have tons of credit card debt, car notes, but what happened was, I guess God placed it on my heart because I've always been really passionate about finances. I'm like, I need something different. Like, I need to get out of debt, and I need to get out of debt fast because I feel like I'm working, but I'm not really getting out. I'm not getting ahead. Like, what is going on? And when I sit down, because it's hard. Like, I have 4 children, but that time I had 3. But anyway, the last one probably came because we were debt free. But yeah, so I'm sitting there and I'm like, I just feel like I'm not getting ahead in life. Like, I need to do something different. So I started breaking down the numbers and I realized like a lot of my check is going towards paying off debt. So I put together a plan, and I did become a financial coach through Dave Ramsey. I don't know if y'all familiar with him, but yeah. So we worked the plan, paid off everything, and in 2021, I was able to leave my job and pursue my dreams full time. So the key to that though is budgeting. And I know oftentimes when we think about budget, we think about like being constricted or, you know, like I can't spend this, I gotta tighten up, and I have to, I have to work, like I'm confined into how I spend my money. But for budgeting, it's not really like that. It's more so you giving your money a plan, and you're telling it where to go. And every dollar that comes into your account, you have a plan for it. You say, okay, I'm gonna put 10%, 20% in savings. I'm gonna do my tithe, I'm gonna do 10%, and then if I know I like to go out to eat, I'm gonna budget this to go out to eat. So that's something I'm very passionate about, and I want you all, I don't know where you are in your budgeting life, but it is something that I encourage you to do as a way to build wealth as well. So not just savings, but when you start to budget and you start to live like a life that you can actually afford, things start to happen, and you can do a lot more than you think. And I don't know everybody, where you are, but I encourage everyone to live a debt-free lifestyle. And so that's what I wanted to say. So now I wanted to talk about the tax benefits of owning a home. And this is just on a personal level. I'm gonna get a little mathy here because I'm a tax accountant, that's what I do. So how many of you all know the tax benefits of owning a home? Or can think of 1 or 2 benefits tax-wise?
Right now.
Yes. Well, let me tell you. Okay, so when we think about taxes, I'm gonna try to simplify this as much as possible. Taxes are pretty complicated, but when you think about taxes, the government is taxing your income, money that you bring in on your Social Security number. And what they do is you have a gross income, and then you have like these deductions and adjustments. And you get down to taxable income, which is the income that they tax. This is like, we're not gonna talk about tax credits and stuff, but we just wanna simplify it and say taxable income. So the government or the IRS, they give you a standard deduction. Y'all probably heard this terminology, and this deduction is based on how you file. Are you married, filing jointly? Are you single? Are you head of household? So the government gives you a standard, and they say, okay, let me just read you the numbers. If you're single, your standard deduction is $14,600 for 2024. If you're head of household, it's $21,900. And if you're married filing jointly, it's $29,200. Okay, so I'm gonna give an example just so you can see how to save, the benefits of owning a home, how to save with taxes, but we're gonna use the example of somebody that's single, okay? So to simplify it, let's say that this person who is single makes $100,000 a year, right? So the government says, okay, well, we want some of that, but we can't take it all. So we're gonna let you have a deduction of $14,600. You're single, you have no dependents. If you subtract that $14,600, you get 85,400 of taxable income. So that is what the government is going to tax. Right. Now, if you have a home, things change. Let me back up for a second. So let's say you're single, right? And you have like, I don't know if you guys go to a tax preparer or you do your own taxes and TurboTax, but they ask you these questions like, what were your medical expenses? Did you give to charity? So let's say that person, they had medical expenses and they gave to charity, right? Let's say they give tithes, so they give 10%. So they gave $10,000 to charity, right? And then let's say they had $1,000 in medical expenses, so that's $1,100. All right. So I say that because back to the standard deduction. So the government gives you the standard deduction. Now, these other things that come into play are underneath something called itemized deduction. So y'all have probably heard that terminology, because your tax preparer will ask you, do you take a standard or do you itemize, or do you not know? Okay, so the government gives you standard, $14,600 as a single. Now, when you own a house, most of the time, you can itemize your deductions, which means that itemize means, okay, government, I appreciate you giving me this, $14,600, but I got something more on my side, on my end. So that takes into consideration when you own a home, you're writing off your property taxes and your mortgage interest. And that is the thing that will take it'll exceed, in most cases, that standard deduction. So like for an example, you're single, you make $100,000, you're still paying your 10% tithes, you have your $1,000 medical expenses, but let's say your property taxes for the year were $5,000. So I'm gonna add that, the $10,000 from charity, plus the $1,000 for medical, $5,000 for property taxes, and then let's say your mortgage interest for the year was $20,000. So then, that is going to total up to $36,000. Is that right? 20, 30? Yes, $36,000. So basically, by owning a home, your property taxes and your mortgage interest, the stuff that you're writing off, it added into this itemized deduction. So the government was going to give you $14,600, but now on your own, you can take an itemized deduction of $36,000. So if you deduct $36,000 from the $100,000, then your taxable income is now $64,000. So now you're paying taxes on $64,000 instead of $85,400 because you were able to itemize your deductions. Does that make sense? Mm-hmm. Any questions on that? Okay. So, yeah. For the next thing I wanted to talk about was the private mortgage insurance. So when you buy your home, a lot of times, if you put down less than 20%, there's a private mortgage insurance that is added to it. So, one thing to help save money, because I'm passionate about budgeting, but I'm really passionate about saving money, and I love teaching people this, is that you can have that private mortgage insurance removed once you have 20% equity in the home. And the way to figure that out is, well, I just look at what's going on in the area to see what houses are selling for. And I'm like, oh, I think I might have some equity in here. But I called the bank and let them know that my property was increasing in value, and I was curious to know if they could remove it. And they couldn't remove it at the time because I didn't. They said I didn't have 20% equity. But about 6 months later, I had it removed. And at that time, it was like maybe $100 to $200 a month. So I wanted to share that with you guys because, again, I don't know where you are in your process, but I didn't know this. So, okay. Yeah, I didn't know it. So when I found out,
this is the first time hearing that you could. So if you have a mortgage, well, that's what FHA wants, right?
Mm-hmm.
So if your equity, so let's say you didn't put 20% in,
Mm-hmm.
but the value of your home over time gives you that 20% equity.
Mm-hmm.
you could use that equity to lessen the mortgage.
Yeah, you can have it removed
Which
completely.
would lower your mortgage.
Yes. You can have it removed completely, yeah.
But that's interesting.
Yeah. And then, since we're talking about mortgage, I wanted to touch on refinancing. And for refinancing, I kind of want to talk about it differently because, like, me personally and a lot of my clients, they're not really, like, they don't really care about, like, investing in non-traditional stuff. Like, my clients tend to be more conservative and they want to invest in, like, mutual funds and stocks and stuff like that. So when we talk about refinancing and when I'm doing coaching in regards to that, we look at it from different ways, but I like to teach from the perspective of retirement, like thinking about your retirement now. So, for example, when we refinance, well, when most people refinance, the goal is to lower the mortgage. That has been my experience. But I kind of take the perspective of, well, what happened if instead of, when you refinance, instead of extending the term to 30 years, you know, adding that back on, what if you increased your mortgage a little bit and you took a shorter term and you paid off your house early? Because a lot of times we have the goal of paying off our house early, and we say, you know what, I'm gonna add extra money to the mortgage to every month, to that principal, to lower the term to pay it off early. But a lot of times life happens. And if I'm not required to give you an extra $200, $300, $400 a month, you're probably not gonna get it. So I kind of like to play with, well, let's think about our house as a retirement plan. So maybe when you refinance, instead of refinancing it to lower the payment, maybe think about shortening the term to 15 or 20 years. So yeah, your mortgage might go up some depending on the interest rates. But if you look at your home as part of your retirement plan, well, in 15, 20 years, your house could be paid for. So imagine you're in your home, you don't have a mortgage. You're just paying your property taxes and your utilities and different, expenses, maintenance and repair stuff that comes with the house. So that's one thing that I wanted to, just bring to your attention as far as an option when we think about retiring, because sometimes it seems so far away, but it's really not. So, do you have any questions for me?
So are you suggesting to add more money to your principal, paying more to shorten your terms, or are you saying to just refinance to shorten your terms?
So what I'm saying, like, okay, if you have a goal, right, and you want to refinance it, like, there's different reasons, because some people refinance it to pull equity out and make improvements, like you do certain things with it. So I'm just saying, like, if you have a goal to pay off your house early, you can add extra money to your principal, and that will automatically have your house paid off a little bit earlier, just depending on how much you add. And then also your mortgage company, if you go into their website, most of them have mortgage calculators too. So you can say, what'll happen if I add an extra $100 a month, $200 a month? Like, they can let you know how sooner you'll pay off your house. So yes, so that was one thing. But then the other thing I was saying was, you can also, when you refinance, you can shorten your term, because then that makes you have to pay it off. You see what I'm saying? Because if you just have, I don't know, for me, when I'm coaching, I like to look at behavioral stuff. And most people are not going to put more down. I mean, you have to be disciplined, and some people will. But most people are not going to put more down on their principal if they don't have to. So I like to think of myself as one of those people who would. But when I refinanced, I took my term from 30 to 20. So, because I already know. Like, I'm passionate about finance and stuff, but I have some behavioral issues. Same reason I don't carry around cash. I'm going to spend it. So.
Is there a tax rate for having like multiple properties, or just having like your second, third, fourth property?
There are some tax credits for having multiple properties, but you have to look at like the amount of income that they bring in, their value. Like, I couldn't tell you off the top of my head about like having multiple properties, but it also depends on like how you're structured. So like, are you the independent owner of these properties, or are they owned by an S corp, or is it a partnership? So it's a lot of things that come into play when you think about real estate. And you have to be careful too, because I would say like a lot of my clients, like I tend to have a lot of married filing joint people with who had homes before they got married, so they're their premarital home. And what happens is a lot of people aren't prepared for this, but they'll put their home as a rental property, and a lot of times we think that we can write off every single thing, including the mortgage. Right, but you can't write off the mortgage. You can only write off the mortgage interest. Yeah. So when you're thinking about putting your home up, just remember that you cannot write off the full mortgage. It's just the interest. I mean, you can still write off the property taxes and all the other repairs and maintenance that go into maintaining the home, but that mortgage is a huge portion. So a lot of times you might think that you're going to have like a loss, or you're not going to have a lot of profit, but when you see that it's not the whole mortgage, it's just the interest. Yeah. So yeah.
I got shocked by that. It's like the income, the rental income was there, and yeah, the IRS had fun with me.
Yeah.
Speaking of the IRS, can you talk more about how you assist your clients with making sure like they're compliant to see when they are, doing their taxes and making sure they're in line with any regulations, even with their investment properties or their current home, or even if they're just filing as a single person?
So one thing that I do is, so let me just talk about a little bit about myself. I'm an enrolled agent with the IRS, meaning that they consider me a tax expert. They've given me my credentials. If you search their website, you'll find me. I have to do training with them every year, 33 hours. So I'm very knowledgeable about the things that they really, really want to see. So I have that, but I also am an accountant as well. So when it comes to preparing your taxes, like I look at it from so many different angles. And then also I have to tell you about my partner, who's my husband, and he's an auditor. So, not for the IRS, but he spent so many years in audit. So we're looking at your taxes from so many different angles. So I have my training with the IRS. One thing that they always want to see is documentation. So I kind of look at it as, I might be a little extra, but when you come to me, can we pass this audit? Doesn't mean you're going to get audited. Your chances are probably even less likely because I prepared the return, but that's the perspective I have. So for my process, I vet you. You go through a questionnaire. And on this questionnaire, I'm asking you questions, kind of like I'm the IRS. Oh, are these your children? How do we know they're your children? Can you provide birth certificates? I don't necessarily ask you to provide them, but I want you to start thinking, oh, okay, like this lady, she a little extra. My other tax professional didn't do all this. But I ask those questions like, do you have documentation to support this? You have a rental property? Do you have QuickBooks? I'm a QuickBooks affiliate. So if you don't have books, guess what? I can get you books. I can get you accounting books, and we can get them at a discount. Because for audits, a lot of times when the IRS is auditing you, if you have your documentation in place, then, or you seem organized, then it's not going to be so bad. If you can say, if they come in and say, I want to see your profit and loss and your balance sheet, oh, sure, that's not a problem. Your audit's going to go a lot different than somebody who's like, oh, I don't have that, but I got these receipts though. So yeah, that's pretty much how we prepare. We keep our documentation of our clients. We have everything on the portal. So we also, another thing that we do is we have, for everybody who's a client of ours, they get audit protection and they get identity theft protection. Because IRS scams and identity theft, like this stuff is running rampant right now. And you really, really want to take care of my clients. So even if you became a client today, you have protection for the last 3 years. Well, if I prepared your return. you get what I'm saying, but like, these are things that we're so passionate about because anything can happen. And you want to be prepared. So to answer your question, documentation is everything. So, and I do ask a lot of questions, and that's first year. And then after that, once I kind of know your business, know your situation, know that these children are your children, then it's fine. But I will also say, too, everybody can't be a client. Because people, like, I can lose my license, and I have worked too hard to become an enrolled agent. So, if somebody comes with foolishness, I can't advise you. I can't advise you. I worked too hard. I had too many mouths to feed, and IRS is fast. I'm not trying to go to jail.
So we have some investors. So what cases we mentioned, like profit and loss statements and all of those things. What are some major things that you're looking for as an enrolled agent, as a tax professional, that they should have in place when they're going through their tax season, as they're running their business, specifically to real estate?
Yeah, I would definitely say books, definitely have the accounting books, but also you want to take into consideration, like you might want to do some planning, some financial planning, and think about, like, instead of, I see this a lot. When it comes to like real estate, sometimes you can be, well, not even real estate, taxes in general, you can be reactive. Like you wait till the end of the year, and then it's the following year, and you're looking back at your taxes. But as a professional, you can get a head start. And if you have your accounting books in order, you can know exactly where you are today, how much money has came in and how much money has went out. And then you can kind of start to think, is there anything that I want to do? Any improvements that I want to make? Now would be the time to do it. There are some items that you're supposed to, like when you make improvements, you're supposed to capitalize them and write them off over time. But there are some items that you can make that investment and write it off that year. So if you know that your business is about to have a lot of profit, it might be the time to invest in something big. Like even, I don't know, maybe you always wanted a business truck. This will be the time, because you have all this profit, to save and take 80% of the cost of the truck, used in section 179 and bonus depreciation, but to lower that taxable income. So I would just definitely say, like, just trying to be in a position where you can look forward and make decisions that way is really good for that. So, but then also, you have to be careful too, because we always want to look at saving money on taxes, but we also want to look at how we operate on a day-to-day basis. Because if you say, okay, I have a whole lot of profit, I'm about to buy this truck, and I'm gonna write it off, and I'm gonna get my taxable income down to nothing. Well, now every month you have to pay for that truck. So you have to take that sort of stuff into consideration as well.
So what would you advise your clients as far as, like, because to what you were saying, how sometimes business owners want to deduct, a lot, but then at the end of the day, you still want to look like you have an income coming in. So how do you advise? I know it's probably on a case-by-case basis, but generally speaking, what would you say for most of your clients? I guess maybe, do you break it down between small, medium, and large, or?
I look at it on a case-to-case basis,
Okay.
But for me, so I always try to take into consideration the client's needs and wants, but I have found most success when you look at it on the day-to-day operational. Because saving on taxes is good, but you gotta be able to operate every single day and be able to afford your life. So I tend to lean towards that side. So
Can you give us a real life example? Like how you advise the business, like what that kind of looks like as far as, okay, they brought in a certain amount and you help them throughout the years in their growth, and so how you allow them to be able to maximize on that growth. Because what you were talking about earlier is how you want them to do it over time instead of, doing it in one instance. If you don't have an example, that's okay.
Well, I'm trying to think. I don't know if I can answer your question exactly,
Okay.
but I have a client and he has the S Corp. And so he came on, it's called, I think we're in our second year. And so we do the accounting and advisory. So we're doing his accounting in real time. And he says, he had, sorry guys, I gotta think. He had, in 2024, he was in the process of potentially obtaining a new contract for 2025. But he wanted to buy a vehicle. It's a huge vehicle. He wanted to buy a vehicle for the business. So I said, well, let's see how 2024 goes, because I know you need a new vehicle, but I don't necessarily want to do this vehicle in 2024 if in 2025 you're expecting all this revenue, because he has very low overhead because he operates out of his house and everybody operates from out of their house. So he has very little overhead. So what happened was, now clients don't always listen, okay? But he started working on it in November. And I'm saying, I'm like, hold on, did he just make a deposit on this truck? What's going on? So he made the deposit and we talked about it, and I was like, I don't know. I said, well, let me do a little bit of research to see what's the tax implications are going to be. So anyway, long story short, I told him after doing research, I said, you can go ahead and take it, because now I can see the whole financial picture for the year, and we're not going to write off the whole truck in this year. This is going to be the time where we're going to allocate it, we're going to depreciate it over 5 years. So we'll take 1 month's worth or 2 months worth for 2024, and then 2025, we're going to take the rest of the depreciation that year. So I think that might answer your question.
No, but
Would
that be the same for like appreciation of like an investment property? So instead of like with the car, depreciated, but like if something that increases in value, then you can write off. You can do the same, but is that?
Yeah, I mean, I think we say the same thing.
Okay.
I think so. But yeah, you have to make a decision. The only way you can make a decision is with accurate information.
Absolutely.
So you do the best that you can in that moment. So we pretty much decided to hold the depreciation for 2025 and just take a little bit. So even though we could have taken 80% of it, we could have taken it, his business would have had a loss, his taxes would have been beautiful for 2024. I said, nah, you need this depreciation for 2025. So that's how we're gonna do it. I mean, he was happy he still got his vehicle. So, yeah.
I did have a question, I'm sorry, guys. So I thought about when you had inheritances, specifically, like, do you handle those as well? Or when you sell your home and it's above, the capital gains and all of that, do you handle that as well?
I do. So for when you sell your home, this is also a good one, because a lot of people don't know this and you get got. So let me tell you. When you sell your home, if you've lived in, I'm not talking about rental properties, but the first property that you live in, you have something called a homeowner's exclusion. I don't know if y'all are familiar with it, but basically it's saying that when you purchase your home, there's a cost, and then when you sell it, hopefully it will have appreciated in value. As long as that difference is not more than $250,000 as a single person, you don't have to pay any capital gains tax on that first $250,000. And if you're married, then it's $500,000. So it's called homeowner's exclusion. Yeah. So a lot of times people will sell their home and their accountant or tax preparer will not know about that, and they end up paying all these capital gains taxes that they never had to pay because their capital gain was not more than $250,000 or $500,000. So Now, there's rules associated with that, like you would have had to live in the home like 2 or 3 out of the 5 years. Like there's some stuff, but like you couldn't have been like a rental property or anything like that.
Anybody got any other questions for Miranda concerning taxes, if you're, just normally or with your real estate? So tell them how they can get her flyers in.
Oh, yes. You can get in, contact me with me on Instagram. My handle is miranda.baisden. My website, baisdenaccounting.com. You can email me, info@baisdenaccounting.com. And please check out my podcast.
Yeah.
The Dex and Randy Show, where my husband and I, we talk about this stuff too, but we talk about the ups and downs of life in general, because life is crazy. Lots of ups and downs, and we share with you the things that we go through in real time and lessons learned. Even if you're into business, you'll probably really like the podcast, because we do have multiple businesses and we talk about that as well.
Amazing. Can you say one more time, like the different things that you can help them with, so that when they contact you, they know exactly what they
Oh, yes. Definitely tax preparation for S corps, partnerships, C corps, individuals. Money, financial coaching, I will help you be debt free. I'll get really passionate and excited about that. So if you're interested in living that type of lifestyle, or if you know someone who is, I'm your woman for that. Accounting, yes. Accounting and advisory. So I can help you get your accounting books in order, and then I can also help you run your business, help you make decisions regarding finances, 401ks, investments, IRAs, and then just like budgeting. I guess that kind of will fall under coaching, but yes.
I have a question for you. So Patrice and I actually meet monthly and we go over our budget and everything, because we all about that debt-free life, trying to do that.
Yeah.
Do you charge for the services? Like, would you be open to like coming in with us, or maybe we can get like a group of people together and we can start something like that, debt-free?
I'm gonna be honest, I charge for everything.
Of course.
I have 4 children. I have a child in college. I have 2 children in private school, and I have a son that has special needs. So my time is very valuable. I charge for everything, but I will be more than happy and more than willing to assist.
That's great.
And isn't your daughter a real estate agent as well?
Yeah, my daughter's a real estate agent as well. Yeah, she just had her first $1 million in sale. She's 20. Yeah, I thought I was going to be a real estate agent one time. I took a course, I can't remember the organization, but it was like, if you're interested in real estate, come to this course. I'm like, I'm interested, because I've been watching these TV shows, I'm going to do it. It's so much work. All I did was take the course, and I said, yeah, I'm probably not going to be able to do that. But yeah.
Well, thank you so much, y'all. I know Miranda from high school. Okay, and we've been out of high school, I ain't gonna tell how. Patrice too. So thank you so much, Miranda. I appreciate you. If y'all don't have any other questions, this concludes our real estate lunch and learn. Please take a sandwich home. You got so much love.